Kim Moody, and I'm your host for In the Mood with Kim G C Moody podcast. This podcast will discuss, educate, and have some lively debate and discussion on tax policy, taxation issues, leadership topics, economics, and the odd political comment as it relates to all of those previous topics, all in a fun and playful style. Come along for the ride.
Well, good day, and welcome to this episode of In the Mood with Kim G C Moody podcast. I'm your host, Kim Moody, and it's been a while since I've done a podcast. I keep promising and to myself and to listeners that I'm going to be more regular, and I'll make that promise again because it is on my list to be more regular. Today, as I record this, it's a beautiful day, and I'm at my cottage, and so I thought I'd record this outside. It's July the 7th. 2026, and I thought I'd talk to you today about a topic I've already done a podcast on almost 2 years ago, as a matter of fact. July 19th of 2024, I did a podcast on people leaving Canada, and since that time, can't believe it's almost 2 years ago I did that, but since that time, nothing has slowed down. There's been continuing activity and lots of attention actually on this subject, so I thought I'd use the opportunity to talk about it today. And because it's such a beautiful day outside and we don't get a very long summer here in Canada and Western Canada, I thought I'd record it outside. So for those who are watching the YouTube version of this podcast or video version, you'll notice that I'm outside today, and that's because I'm taking advantage of the nice weather at my cottage here. So let's talk about this, leaving Canada. Let's just maybe frame it in terms of how Canada taxes. I mean, most of us know that Canada taxes on a residency basis. If you're a resident of Canada, then you're taxed on a worldwide basis. But what does resident mean? Well, resident can mean spending too much time in Canada, which if you are, then you're deemed to be resident of Canada, and that's 183 days or more. There's some other technical rules in the Act with respect to deemed residency, but I won't get into that. They're pretty rare in the whole scheme of things. But the more common is factual residency. If you live and breathe in Canada, if your center of economic interest is in Canada, if your family's in Canada, your dependents are in Canada, then you're more than likely a resident of Canada, factually resident of Canada. There's no definition of residency in the Income Tax Act other than deemed residency that I've already mentioned, but factual residency, there's no definition. And so it's been left to the courts over the years, and the leading case by far is a 1940s decision of the Supreme Court of Canada called Thompson. And oversimplifying Thompson, it basically looks at a primary test and secondary factors, secondary tests. And the primary factors are essentially where do you live, where do your dependents live, and where do you make a living. And again, for tax geeks who are listening to this, you can knit me to death on that, but that's kind of the plain English primary factors. Where do you live, where do your dependents live, where do you make a living. And then the secondary factors are basically tell the story, like they help tell the story of the primary factors. That's how I describe it to clients, is they help tell the story. So it's basically things like where are your bank accounts? Where's your driver's license? Where's your health care provider? Where's your credit cards? Where's your social ties, like memberships in clubs and things like that? Those basically help tell the story or bind the primary factors together. That's how I describe it to clients. And the CRA actually, in one of their folios, I can't remember it off the top of my head, does a very, very good job of summarizing the case law in this area and what factual residency might look like. So I'd encourage you to take a look at that folio, which is you can easily find it by just simply searching CRA folio income tax residency for individuals, and you'll find it. And so that's basically oversimplified, that's what residency is. But what happens when you become a non-resident of Canada? Well, because Canada taxes on residency, not citizenship, which, just as a quick aside, there's only two countries in the world that we know of that taxes on citizenship. And of course, the most common one is the gorilla, which is the United States. They tax on a citizenship basis. If you're a citizen of the United States, then you are taxed on your worldwide income, regardless of where you live, regardless of where you're resident. And that can extend to green card holders as well, permanent residents. So if you're a permanent resident, green card holder, then you're treated as a U.S. taxpayer. There's other deemed residency, like if you spend too much time in the United States, they have a similar 183-day rule. They also have a substantial presence test, which I won't get into here, but the bottom line is citizenship has no consequence in terms of residency for tax in Canadian tax matters. So yes, you're a Canadian citizen, that's fine. That has nothing to do with determining whether or not you're a resident of Canada. So back to what happens when you're a non-resident or become a non-resident. So let's say you move to the United States, which is by far the most common. If you move to the United States and set up your life in the United States and you sever your ties with Canada, so you sever your primary ties, you sever your secondary ties, then the way the Income Tax Act works is that you are deemed to have disposed of all of your assets at fair market value. And so if there's any unrealized gains as a result of holding those properties, then you're going to pay tax. Now, there are 5 buckets of exceptions to I call it departure tax. Most tax persons in Canada will call it departure tax. But if you understand the basic principle of what a departure tax is, it's very similar to what happens on death. On death, you're deemed to have disposed of all of your property at fair market value, and any unrealized gains or unrealized income is deemed to be realized. There are rollovers on death to surviving spouses or common law partners, and there's some other very specific rollover rules for certain adult or disabled children or trusts there too, but I won't get into those nits. The departure tax doesn't have those types of death exceptions. The 5 buckets of exceptions for for avoiding departure tax, the most common are the first 2. Canadian real estate that's held personally and registered assets. Those are the 2. I won't get into the other 3 because they're very specific and nuanced and reserved for complex situations in most of the cases. But the most common, again, are personal real estate Canadian real estate held personally. So just to nit on that, if they're Canadian real estate, let's say you have rental properties, and they're held by partnerships or they're held by corporations, no exceptions, because your partnership interest or your shares of the private corporation that you hold those interests, those are deemed disposed of at fair market value, regardless of the fact that it holds Canadian real estate. But if you hold the Canadian real estate personally, not through any other legal relationship or legal entity, then you're accepted from the departure tax. Now, why is that? Well, the reason for that is actually quite simple. Canada, like most sophisticated countries in the world, will always reserve the right to tax people who dispose of their dirt. So if I'm a non-resident and I continue to hold Canadian rental properties and then I turn around and sell those Canadian rental properties, Canada has the first right to tax that. And you're going to have to go through Section 116 of the Income Tax Act to make sure the proper withholdings are done and the proper payments are done. And there's some follow-up filings that need to do that. So anybody who's familiar with non-residents disposing of Canadian real estate, you'll be familiar with the so-called clearance certificate application. I won't get into that, but the bottom line is Canada will eventually get its pound of flesh on the disposition of the real estate or the deemed disposition. In other words, if you die as a non-resident of Canada holding Canadian real estate, that's a deemed disposition for Canadian tax purposes, and there's tax owing. So that's the obvious policy reason why there's no departure tax if you hold personal real estate directly. There is no exception, again, if you hold that real estate through corporations or partnerships or a trust. But if you hold it personally, there is. The other exceptions are, for example, registered plans like RSPs and RIFs, registered retirement income funds. The reason there's no exception, the reason why there's no departure tax if you hold RSPs is because, again, Canada will get its pound of flesh when you withdraw on those registered plans. There's a withholding tax of 25% when you withdraw as a non-resident of Canada, or when you die. And so again, it's Canada provides that exception in a logical way, in my view, because it will eventually get its tax. For just to, put the tie the ribbon on the bow here, put the bow on. Yeah, you know the saying I'm saying. But for TFSAs, the contribution limits are suspended if you're a non-resident. In other words, you get no further contribution limits, but you can continue to hold the TFSA. But the problem with many situations of holding a TFSA, especially if you move to the United States, is there's significant reporting requirements. You will more than likely not get tax-deferred or tax-free treatment, so you got to be careful of that as well. So an obvious plan is to collapse TFSAs, but that's really dependent on the facts and something to consider with your own advisors. So that's kind of the big bucket. Now, what's the policy reason for deeming assets to be disposed of? Well, again, it's the last time that Canada will be able to tax you on capital gains or income, and so it wants to ensure that it gets its so-called pound of flesh before you leave Canada. Now, I'll comment on that more in a second here, but this was really highlighted recently when Gad Saad, if you're familiar with him, he's a quite popular writer and speaker, and he's a professor at McGill University in Montreal. So he's Canadian, and he made the case, or not made the case, he made the announcement a long time ago that he's going to leave Canada. Now, I don't know him personally, I don't know his situation, but on June the 18th, I just had to look at my notes here, June 18th, 2026, he put out a tweet on X saying that he was in shock because he had come from his accountant's office, after having a meeting to determine how much he's going to have to pay in departure tax, and he was floored. Now, again, I don't know his personal situation, but more than likely he has a significant amount of royalties that he receives off sales of his books and maybe some intellectual property. Maybe he holds all this through a private corporation, and if he does, then the shares of his private corporation are deemed to be disposed of at fair market value, which would include the intellectual property and the royalties that are held in that company. Now, again, I'm just speculating. I have no idea. But would it come as a shock to him that those gains on those shares, for example, of his private company that holds those assets are deemed to be disposed of? Yeah, probably. And so, that particular tweet got a large pickup on X. And some of the commentary was quite uninformed. For example, a very common rebuttal was, how dare Canada have this tax? I paid tax all my life, and now they want to, extort me on the way out. Well, that's a very simplistic understanding of Canada's tax system. For people that have paid their tax all their life, yes, just like me, just like you, it really depends on what you reinvest your after-tax monies in. If you reinvest in GICs, for example, and then continue to pay ongoing tax on those GICs for the interest income that you receive annually, well, of course, there's no departure tax because it's all tax paid. But if you happen to reinvest your after-tax monies, your salaries, your wages, into, let's say, stock that all of a sudden goes up in value a significant amount. Let's say it's Apple stock. Apple stock has grown tremendously over the years. So has some other stocks, lots of tech stocks, for example. the idea is that when you're a resident of Canada, you're going to pay tax, and pay tax on any gains that you realize. And so this is Canada's way of saying, hey, you've been in Canada, you've had the benefits of Canada, and therefore we're going to deem you to realize those benefits, those unrealized gains, immediately prior to you becoming a non-resident Canada. I explained that on that in a tweet to try to set the stage, or not stage, but set the record straight in terms of what Gad Saad was saying and some of his followers. But boy, oh boy, did I get crucified for saying that the policy is that you're going to, if you've benefited from Canada during the time that you're in Canada, then of course any unrealized gains should be triggered, and that is exactly what Canada does. People crucified me for using the word benefit because some people say that where's the benefits, and I think that kind of thinking is rather shallow. We have a great country that provides significant benefits. Yes, we have our issues currently. We've had our issues historically. I'm certainly no big fan of our current government and, the big spending approach that we have and the big daddy approach with privacy issues and what have you. We have issues with property rights in British Columbia, which, et cetera, et cetera. The challenges go on. But there is no question that, in my view, that as a Canadian, you benefit from an overall stable society, generally peaceful society. And so for me, I don't wish to get into that debate about benefit. But having said that, the tax system is set up so as to realize any unrealized gains subject to these exceptions that I've talked to you about. And so, in response to that Gad Saad tweet, the whole idea of Canada having an exit tax has gotten a lot of attention. This is not a new issue. Canada has had a departure tax, as I loosely call it, for decades and decades. And I think the policy is sound, and I don't think the policy is going away anytime soon. Now, with all that said, are we seeing a lot of people leaving Canada? Yes, we are. I wrote about this many times in my Financial Post articles, and as I mentioned off the top, the last time I talked about this in a podcast was July 19th of 2024, and boy, oh boy, the number of files that we continue to work on in my firm accelerates. And tax doesn't tend to be the sole reason why people leave Canada. But it certainly is a significant factor. There's a recent study put out by the University of Calgary School of Public Policy, and one of the authors was my good friend Jack Mintz, and if you Google it, you'll find it. It was released in, I believe it was June of 2026, and it looked at the reasons why people leave Canada. And to my surprise, but actually not really, one of the significant reasons why we see people leaving Canada, especially older ones, is for healthcare. Canada has long been proud of its socialized and publicly available healthcare, but I think it's well known that we have its challenges with healthcare, and for people that rely on that or need more immediate service or attention, they're looking south of the border or elsewhere for that matter in the world. And so healthcare tends to be number one. Economics tends to be number two, and taxes was number three, if I recall correctly. And that's, that ordering tends to be consistent with the files that I experience on an ongoing basis with respect to the numbers of people leaving Canada. Now, I keep ringing the alarm bell in terms of the numbers of files we're working on. Let me just remind what I've written about and what some of my colleagues have talked about as well. For the first 23 years of my career, I worked on maybe a dozen departure files. People leaving Canada. Generally, it was, to move to a warmer climate, maybe be with their grandkids and kids who had moved away from Canada. But it was generally lifestyle, and they wanted to make sure that the tax matters are handled correctly. And so that's, those dozen files are over the first 23 years of my career. Pretty straightforward files. ever since 2015, when the Liberal Party got elected, Justin Trudeau got elected, and one of the first things he did was, ask the wealthy to pay just a little bit more and increase the top rate by 4%. And then in Alberta, we had the NDP come into power unexpectedly, and they increased the provincial tax rate by 5%. And so we've, with that 5% plus 4% is 9% increase in personal tax over the span of about roughly 18 months. In Alberta, my home province, that was a major push towards people leaving Canada. And also planning to accelerate income for people that weren't wanting to leave Canada. But that was the start. And then fast forward to all the other poor tax policies that have been introduced over the years by the Liberal government, including this current government of Mark Carney. And it's been just an unbelievable amount of successful Canadians leaving Canada. Now, how many files have I worked on in the last 11 years? Well, my colleagues and I, going from roughly a dozen files in 23 years, I always get the audience whenever I speak on this topic to guess, and I usually get 100 or 200. No, that number is now well over 1,000 files, with a good chunk of those people actually closing the files. In other words, leaving. There's some that don't. Like Gad Saad, they get shocked by what the tax is and decide to, stick it out. But a good chunk of people have left, with the wealth being into the tens of billions. I've never tracked the exact amount of numbers, and certainly you can't find this from Statistics Canada as well. I recently had a debate with a Liberal MP on this subject. I said, I asked him if he was aware of the number of successful Canadians leaving Canada, and he kind of scoffed at me and said, "Hey, we've got more people coming into Canada than are leaving." And I said, "Well, that might be true, because it is true, but have you looked at the wealth attached to the people coming into Canada versus the wealth that's leaving?" And if you don't believe me, come and sit in my office and see the files that I'm working on. I'll certainly cleanse the files for confidentiality, of course. And I've offered this, to people that don't believe the warning bells that I've been ringing, and others. There's many other tax practitioners across Canada who've been ringing the alarm bells as well. And unfortunately, nobody has taken me up on this offer. They'd much rather stick to their ideological script or their speaking points that Canada attracts more people than are leaving. While that might be true in terms of straight population, but it's certainly not true with respect to wealth leaving Canada. And when you have billions and billions of dollars leaving Canada, that puts pressure on our overall income tax system, because those billions that are leaving generate significant personal tax revenues, corporate tax revenues, and when those are no longer available, it takes a lot of new Canadians, to replace those small amount of Canadians that are leaving. And so the numbers that we're working on, just to reiterate, is well over 1,000 files in the last 11 years, with billions attached to of wealth. And it's sad. It's very sad, because Canada needs to attract wealth. It needs to attract successful people. And when you see, for example, how Elon Musk was vilified by the left-leaning media. I mean, we even had the Globe and Mail have a headline that that it ultimately rescinded and replaced. But the original headline was, "Elon Musk, here's a guide on how to hate him more," or something like that. I can't remember, because I was so disgusted with that headline, and I actually wrote about it in one of my Financial Post articles. I wrote a Financial Post article about how we need to celebrate success and attract people like Elon Musk. We don't have anybody like Elon Musk with that level of wealth coming to Canada anytime soon, or even developing. If they're developing, certainly I'm not aware of it. I certainly hope that we have some developing, tech superstars or other entrepreneurial superstars in the works. But I highly doubt it. And the reason why is because our economic environment is just not conducive. Our policies are not conducive to celebrating success, to encouraging success. And instead, we have left-leaning media with its readership who drink the Kool-Aid or drink the ideology that Elon Musk is an evil person. When I wrote the piece in the Financial Post, I got vilified with a lot of hate mail that came my way saying, how dare you celebrate a child killer? Apparently he's a child killer because he was involved in some cost-cutting measures for the Trump government. And apparently those cost-cutting measures cut off aid to kids. I mean, listen, I'm no expert when it comes to this stuff, but to tie a straight line to that kind of stuff and pin it on Musk's head is absolutely ridiculous, and instead feeds an ideology rather than based on fact. And so, again, we need to celebrate success in Canada. We need to have the environmental policies to encourage investment, encourage risk. And let me give an example from a tax perspective of where this goes offside. So I've written about this a little while ago, and I've spoken on this lots, but about 5 years ago during the Trudeau realm, there was a promise made that they're going to study employee ownership trusts as a measure for people, entrepreneurs, to sell their businesses to these employee ownership trusts. Because other countries around the world, like the UK and to a limited extent the United States, have had such vehicles around and provided tax-deferred transfers or tax preference transfers of entrepreneurs to these employee ownership trusts. And what they are basically, they can be a cooperative or a trust. Sticking with the trust model, the beneficiaries of the trust would be the employees, and the trustees of the trust would typically be the employees or a select group of them. And so basically it's all employee owned, employee controlled. Sounds good, right? But it does fit into a left-leaning ideology that employees are the ones that ultimately are best suited to control organizations. And I have no opinion on that other than in some cases it very well might be the case. In some cases it's probably not the case. But to paint it with a one brush, I don't think is fair. And so ultimately, after some study, Canada proposed some rules. I believe it was in the 2022 or 23 budget off the top of my head, that they would allow for certain transfers of interest, entrepreneurial interest, shares of private corporations, to a newly created employee ownership trust. However, the existing entrepreneur would not be allowed to be a beneficiary of the employee ownership trust and would not be allowed to be a trustee, and can't even be factually involved in the operations. And they would get paid from future earnings of the trust rather than getting a check, and so there are some tax rules introduced to allow for relief, because normally when there's debt owing from a private corporation to an entrepreneur, there can be bad consequences, like 15.2 of the Act for any tax geeks that are listening. But there is some relief proposed, along with some capital gains deferral as well. Well, the pickup on this was pretty small, as one would likely imagine, because if you're an entrepreneur, you've risked your whole life in many cases, and risked assets. You've worked hard, and you're going to sell your business to employee ownership trust to get maybe some tax deferral on the resulting capital gain. But you can't be involved, so you're taking all the risk and not getting paid, and hope that ultimately there's going to be earnings to pay you. Yeah. So the pickup was predicted to be almost nil by the parliamentary budget officer, on this. And in real life, the pickup was small. There was a small group of financial advisors who loved this idea and started promoting it. I even had some, approach my office, and ultimately I would push back and say, listen, I don't know of one entrepreneur who's that, philanthropic, if you want to call it that, that they're prepared to hand over the golden goose to their employees and take all the risk on future payments and not be involved in making sure the golden goose doesn't get, cooked. And sure enough, the government, I think, realized that they needed to add a sweetener. And so what they did in the 24 budget, I believe it was, is they said, okay, for any entrepreneur that does this, we'll sweeten the pot. We'll give them a $10 million capital gains exemption. $10 million. Well, you could probably make that $100 million if the parameters are still the same, because ultimately the entrepreneur still takes all the risk. And originally they proposed a 3-year $10 million availability from 24, 25, 26. Well, recently in the so-called Spring Economic Update in April of this year, April 28th of this year, the government announced that they're going to make that exemption permanent. And again, they can make it permanent all they want. They can make it $50 million. They can make it a $100 million exemption. The foundational problem remains that nobody, certainly in my client list, would ever be prepared to turn over the keys and assume all the risk. So again, the pickup on this will be small. Now, why am I explaining this long-winded? Well, because the current capital gains deduction for normal businesses, small business corporations, or what's referred to as qualified small business corporation shares, is $1.25 million. And that's the same for farming property and the same for qualified fishing property as well. 1.25. But the government is prepared to give $10 million if you transfer to employee ownership trust? You reconcile that logic for me, because I certainly can't, other than it becomes politics, where we have a left-leaning ideology that encourages transfer of businesses to employees, but we only have 1.25 capital gains deduction available for normal businesses. That's where we need to, as I say, make the environment better and more enticing for entrepreneurs to risk their capital. That is a complete mismatch, and it needs to be fixed. Even if it was fixed to match the employee ownership trust of $10 million. Now, yes, that's going to cost the government a fair amount of money, because the pickup on capital gains deduction for normal businesses is significantly higher than what it will be for employee ownership trust, which will be basically zero. And so that's a mismatch. A bigger mismatch is personal tax rates. We need to really look hard at how Canada taxes individuals, especially in light of AI pressures, which is going to put pressure on the labor market. I've written about this as well, and how much Canada relies on personal tax revenues, which is roughly 43%. It varies by year from anywhere from 43 to about 47%, but it's in that neighborhood. That's a tremendous amount of reliance on labor and personal tax revenues. And so we need to rethink on how we do that. But overall, we need to encourage people to work. And having high personal tax rates that exceed 50% in provinces like Ontario and British Columbia and the Atlantic provinces and Quebec, in Manitoba, that makes no sense. We need to really fix that. We need to look at how competitive we are corporately. We are generally competitive corporately with the United States that have, the higher corporate tax rate states. But in some states, like Texas and Florida, we're not competitive. And so we need to fix that. So there's a lot of other things we need to do as a country. But I do think it's overall, we as Canadians, we need to become more financially literate. And we need, as a result of such improved financial literacy, which is easier said than done. People are not going to try to improve their financial literacy if the first thing they worry about is that they've got to put food on the table for their kids. I get that. But all Canadians can make better informed choices in terms of how they pay for things, what they're spending their money on, who they vote for, because who they vote for has consequences. And economic policies matter. It hits our pocketbooks, and certainly on the tax side, it matters. So, with all that, I hope you got something out of today. We as a country have a lot of work to do, and one of the first things we need to do is to improve the economic and tax policies of our country. Rather than spend, and hand out money here and there, we need to encourage investment, encourage risk-taking for entrepreneurs, and ultimately those benefits will benefit all Canadians. So, thanks very much. I hope you enjoyed this. If you do, please share, please subscribe, and I'm always open for comments and suggestions. So thanks very much. Until next time, bye now.
Well, there you have it. Another episode of In the Mood with G C Moody podcast. I hope you enjoyed it as much as I did. Make sure you like and subscribe and share it with people if you think they'd enjoy it. Until next time, have a great day.